I feel it's important I talk about how market volatility shapes, investor behavior and overall market psychology. How does volatility shapes market behavior and the psychology of market participants, market psychology. So in this case, you talk about impacts on investor behavior, the impact of psychology, the impact of volatility, rather on investor behavior. In this case, you consider fear and panic selling. Fear and panic selling. During periods of high volatility, investors may experience fear, leading them to sell their holding in a rush to avoid further losses. When the market is declining, people are gripped by fear, by panic. They, sell their shares to avoid, sustaining, further losses. This can result in a sharp decline in stock prices, even for fundamentally strong companies, as fear overrides rational decision making. That's the problem. People end up selling stocks of companies that are doing well, fundamentally sound because of the emotions of fear. We equally want to talk about greed and speculation. Greed and speculation. So on the flip side, periods of rising volatility often bring, out that particular emotion, that particular sense of greed, leading to speculative behavior. Investors may, charge high returns on the volatile markets. They may want to chase returns. The market is volatile and the stock prices are increasing. Investors will now pour in chasing returns. In the typical volatile market, taking in more risks than they should, under normal circumstances, hoping for a quick profit. Asset prices are increasing, actually, almost, beyond what the fundamentals will support. Yet investors keep on, buying because they don't want to miss out of the potential gains, and they end up, in an overbought, market condition because they want to chase, quick profits. There's also what is called, overreaction to news. Overreaction to news. Volatile markets, makes investors more susceptible to overreacting to news, whether positive or negative. Small news events could lead to exaggerated market moves as investors, react impulsively to short-term information. In the case of positive news, they become over-optimistic, and euphoric. In the case of negative news, they become kind of pessimistic and, end up, selling in a panic. This is what you call, herd mentality. Investors equally, give into herd mentality. Investors' behavior during volatile times is often driven by herd mentality, where individuals follow the actions of the crowd. Whether the crowd is right or not, they simply do what? Follow the action of the crowd, instead of relying on their own individual research and personal conclusion as it relates to the company they've invested in or they want to invest in. They simply follow the crowd and they dump their strategy, their personal strategies, and then follow what market participants are doing. Well, sometimes sometimes the crowd is not always right. The crowd is not always right. It might be right at times, but it's never always right. So this can amplify market movements, leading to bubbles or crashes based on collective emotions rather than fundamentals. That collective emotion, the crowd, can cause the market to even crash, can bring about a crash in the market, can even lead to bubbles. Another one is loss aversion. Loss aversion. Investors are often more sensitive to losses than gain because the pains of losses is even more than the joy of gains. This can lock in losses and prevent them from participating in market recoveries because of the pains they've encountered. they would kind of wouldn't want to participate again in the market and will miss out of potential gains in the future. There's what is called, avoidance of risk avoidance. In times of heightened volatility, investors may become more risk averse, shifting away from, riskier assets and, opting for safer investments like bonds and holding cash. While these help mitigate, immediate losses, it may limit potential gains, or potential gains over the long term. They become fearful. They want to avoid losses by all means. They hold on to cash and onto bonds, and then will miss out of recovery in the markets. So this is the impact of the impact of volatility on investor behavior. We want to look at impact on market psychology. What is the impact of volatility on market psychology? If we examine the impact of volatility on investor behavior, we want to see precisely the impact of volatility on overall market psychology. So number one is an increase uncertainty. This increase, uncertainty. Market volatility creates an atmosphere of uncertainty where further market direction or future market directions, are harder to predict because of the volatility, stock climbing and falling. People find it very difficult to predict what will happen next. And so this uncertainty can cause investor anxiety. During, in this period, it drives, it tends to drive market behavior towards safety and, into people now adopt, they become risk averse. It reduces, their appetite to take risk. Not only that, it equally, induces volatility clusters, what is called volatility clusters. So in this case, market tends to experience periods of heightened volatility, often refers to as volatility clusters, where large swings in prices are followed by more larger swings, just larger swings followed by more larger swings, creating what is called volatility clusters. This can lead to more erratic market psychology, with investors swinging between optimism and pessimism in response to shifting, market conditions. When the conditions, when the fluctuation goes high, people, have that, increase, optimism. When it goes down, they experience increase, pessimism. So we equally want to talk about confirmation bias. Confirmation bias is a very important market psychology that is created by volatility. During volatile periods, investors are more likely to seek out information that confirms their pre-existing belief, that tends to confirm what's the belief system or the belief they have concerning the markets. It reinforces, it reinforces market trends, whether bullish or bearish. It tends to they believe, or they seek out information that will confirm what they earlier believe, and they disregard what does not confirm their belief. And this will tend to exaggerate or worsen market conditions further. Whether it is a bullish condition, whether it's a bearish condition, it worsens the entire market condition. Please subscribe to this channel and like this video. There's risk on, risk off, risk on, risk off. So volatility can trigger risk on, risk off mentality, in which investors quickly move between high risk assets like stocks and commodities and lower risk assets like bond and cash based on market conditions. It is all switch on a very fast pace. From the safety of stock and commodities, rather from the risk of stocks and commodities to the safety of cash and bonds, and they do that at a very fast pace. So risk on, they are in risky assets. Risk off, they are in less risky assets, and they do that at a faster pace. Then there's that short-term focus. Short-term focus. So on volatility, on during market volatility, on a volatile market, discover that investors may become more focused on short-term movements, sometimes losing sight of their long-term investment goals. This shift is often, this shift in focus leads to impulsive trading decisions, such as reacting to price fluctuations, which may hurt long-term returns. So protecting your portfolio by using options and hedging strategies is very, very important during times of during periods of increased volatility. You could decide to use options, and you may decide to use hedging strategies. But all the same, you must bear in mind that volatility impacts investor behavior as well as impacts market psychology. We need to understand this particular factor so as to be precise, so as to be able to take informed decisions when it comes to our when it comes to our investing.